Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're
creators
going mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome to Altco's Mainstream's What's Your Edge? Every fund and every company needs to have an edge. In every podcast, I like to ask my guests, what's your edge? Every person, every company, every fund has something that makes them special, makes them stand out from the crowd, gives them an unfair advantage, tips the scales to the odds of success. In this episode, I ask our special guest, Bob Long, what's your edge? Bob is the CEO of StepStone Private Wealth. He has 3 decades of experience in the private markets and has led investment teams for global firms in both the general partner and the limited partner role. He served as the CEO of 2 publicly traded companies focused on expanding private markets access for high net worth investors. Prior to StepStone Private Wealth, Bob was the CEO of OHA Investment Corporation, a publicly traded specialty finance company. Previously, he co-founded Conversus Capital, the largest publicly traded fund of third-party private equity funds with $3 billion of AUM, and served as its CEO. He previously led Bank of America's $7 billion strategic capital division. And early in his career, Bob served as the lead in-house counsel for a large portion of Bank of America's investment banking division and worked as a securities lawyer for a major law firm. A recognized industry leader, Bob was named one of the 50 game changers by Private Equity International, has been profiled in the Wall Street Journal, and hosted CNBC Squawk Box Europe on numerous occasions. Thanks, Bob, for coming on the show to share StepStone's edge.
We're going mainstream.
Bob, welcome to What's Your Edge?
Thank you. Looking forward to this for a while.
Pleasure to have you here. You've built such a fascinating platform at StepStone Private Wealth and at StepStone more broadly. Your background has been fascinating and has kind of led you to the point of being a leader in the evergreen space. I'd love to start there so that we can then get into the whole conversation about evergreens.
Is that a nice way of saying I can't keep a job?
Or just you have a lot of experience.
I am one of few individuals who has been the CEO of a publicly traded fund of private equity funds in Europe, a publicly traded alternative company in the US, a publicly traded business development company, had a major role as a limited partner and a major role as a general partner. So those 4 experiences have really informed what we've built at StepStone Private Wealth.
What was it like running those businesses in public markets before, one, really alternative asset managers were understood in public markets, and 2, now that you have these listed vehicles in the evergreen space, that's more commonplace now, but it wasn't when you were running these types of vehicles.
There were some lessons, and I think the key lesson is convenience of investors really matters. From 2007 to 2012, I ran, along with my current partner, Tim Smith, the largest publicly traded fund of private equity funds. And we had outstanding investment performance. We exceeded the S&P 500 and our NAV growth by 500 basis points per year. And you would think that would lead your stock to trade well, and we were well followed by the equity analyst and quite successful in our investment side, but those structures just did not work. The listed funds in Europe have traded and continued to trade despite being run by very highly respected and great managers that we know and compete with. Those have traded at perennial discounts of 20% or more. And in my opinion, maybe somewhat controversial, those structures just don't work. And so what I learned and what I got from that, running a publicly traded fund in Europe, running a BDC in the United States that was listed on NASDAQ, structure and convenience really matters. And the evergreen fund in its current format, most of which have 5% per quarter liquidity, is a compromise, but it is a compromise that suits a large portion of the people adequately. So your publicly traded exposure, including to alternative assets, like through REITs, you can get exposure to real estate, or through BDCs to private credit. You can trade that every day. but you may not like the price. It will often trade at a material discount or dislocation to net asset value. With an evergreen fund, you cannot sell it every day. You can generally sell it every quarter, but you will like the price. You'll get 100% of NAV. And so that hybrid, that compromise has seemed to work both for sponsors of funds like ourselves, financial advisors, and their clients.
So that's a great jumping off point to what is really the point of an evergreen structure. There are benefits for GPs, there are benefits for LPs. I'd love for you to get into that, and then we can get into StepStone and how you've structured your evergreen funds.
Sure. The benefits for investors are convenience and the ability to compound your capital. Howard Marks is attributed the following quote, which I love: "You can't eat IRR." And drawdown funds are designed, and do, the good ones, deliver an attractive internal rate of return in comparison to the public market equivalent. And that's been well established for the stronger managers. But the fact you have unpredictable calls and distributions, and to quote one of your other guests, you are committed to a fund and not actually always invested in that fund, that is a challenge. Your money's not at work. And the benefit of the evergreen fund is, if you commit today to S Prime, our core private equity fund, which does take subscriptions every day, so you could do this, and probably you should. I brought a subdoc with me. You will be immediately invested for your full intended exposure. And so that's the big advantage. It gets you immediately invested. You know what you're invested in. It delivers a 1099 rather than a K1, which we can get into. And it allows you to not only compound your gains, but also dollar cost average. So if you invested today and tomorrow we have a realization event, and by the way, in that fund, it's $3 billion, it's 2,500 underlying companies, we basically have a realization event of some sort every day. And we're reinvesting that capital. So you indirectly, in your investment in S Prime, you're dollar cost averaging. And so the evergreen funds have given financial advisors some of the tools they had in the public markets, or analogous tools, that they just didn't have before. So I think that's a good thing for investors. They're not perfect. You can't sell them every day. The liquidity is limited. There are some limitations on the information as a public, because we are public companies, that we can provide, but they seem to be working for people. Advantages to the general partner or the sponsor of the funds: permanent capital allows you to consistently invest. And so there are clearly advantages to us and to the individual investors that buy our funds.
And to the GPs too, because then GPs don't have to sell.
Exactly. So we're investing in funds. The funds we invest in aren't doing anything differently, but nonetheless, we are a permanent source of capital to them. So we are a very good buyer of continuation funds, something I think you've talked about on the show before. We are a very good buyer of secondaries, because these evergreen funds, a critical element is they are designed to start and stay on the upswing of the J curve. That's just critical. You can't have a trough of negative returns in an evergreen fund for it to be attractive to investors. So you buy secondaries, you buy them at discounts to net asset value. You do take those discounts up front as required by GAAP. By the way, if you only invest in funds where you get the return from the upfront discount, the pop, you won't be very successful. You have to invest in underlying assets that appreciate from par, as my colleague Mike Elio likes to say. It's return from par is also critical. But you do those things to start and stay on the upswing of the J curve. So we are a very good buyer of secondaries.
So that's a great segue into StepStone as a business, because
Sure.
StepStone has both secondaries capabilities, it has data, and then StepStone Private Wealth, you've created all of these products around some of those features. Would love to understand more about StepStone, why you decided to build StepStone Private Wealth within the complex of StepStone more broadly as well.
To maintain an evergreen fund and recognize it's a challenge. We raise money in S Prime, and we'll talk about our other 4 funds. 3 of our funds have daily inflows. So I don't necessarily know, or more importantly, our portfolio managers who are actually making the investment decisions. We've got a pretty good idea at this point with some history But we don't exactly know what capital is coming in tomorrow and the next day and the next day. But to generate our target returns, we can't have much cash drag. We need to get the capital invested. We also can't predict with great certainty what our quarterly redemptions will be. We just had a quarterly redemption for S Prime. It was about 1.4%. It's been 1 to 1.4% since we started. It's been lower at times, but that's been the high water mark. But we don't actually know until the day before. So maintaining the balance of inflows and outflows, staying invested is frankly very, very difficult. But there are two things you need to do, and I understood this from my public company experience. Two things that a sponsor of a evergreen fund needs to have. First, a lot of deal flow, a lot, because the pieces and parts that provide the liquidity and the return, and we could talk about that, the mix of liquidity and return. There are many good deals out there, but they may be too long in duration for the evergreen fund, even though the return might be attractive. You need to balance, and what we're always doing is balancing duration or liquidity with return. So you need a lot of transactions to pick from to have enough to get that right mix, to keep that balance, first. And secondly, you need best-in-class tools to interrogate the data you have about each deal to predict as best possible, we're not perfect, but we're pretty darn good, at when that asset will exit. And by the way, I'm sure it's obvious to your audience that a lot of diversity in the underlying helps, because we'll be wrong, but we'll be close. And when you're spread across 25 underlying companies, $3 billion of AUM at S Prime, our core private markets fund, we're getting pretty good at determining how to manage the cash and match those inflows and outflows. The reason we brought the team this idea to StepStone 5 years ago was we are one of, if not the largest allocators to the private markets globally, putting out $70 billion a year. That's closed deals. That's not a pipeline or a funnel. That's closed deals and about 500 separate transactions. So that flow was there. And then the proprietary tools known as SPY, StepStone Private Intelligence, those tools and the flow were why we brought the team there.
On that point, how much does that help on the secondary side in terms of the data that you get to be able to price secondary transactions the way that you feel is as close to the numbers or returns that you think you can generate because you know how to actually price these deals?
We believe that our data advantage is a very significant competitive advantage. As one of the largest allocators, the amount of capital we're putting out to these general partners when they launch new funds, I think it's well understood. When a fund is sold in the secondary market, an LP interest is sold, the general partners don't make any money. It's a pain in the butt for them, actually, and they make you pay their legal fees to do the transaction. So because we are really important to many, if not most, of the world's most important general partners, the largest and most successful, then they are motivated to provide us data about their existing funds, to take our calls, to go in depth on what's going on in your fund 4 that this pension fund is interested in selling because they have a liquidity crunch, down through when we underwrite each underlying company and determine when we think it will exit and at what value. So the amount of primary capital we put out, along with this set of proprietary tools we've built, we believe is a very significant competitive advantage, and I think our track record reflects that.
And then how does that inform how you think about portfolio construction?
We are big believers in diversification. So first and foremost, we're an open architecture firm. These are not StepStone proprietary transactions. We are manager diversified, along with being diversified on every other key metric, geography, size, industry, et cetera. We focus very much on portfolio construction. So, for example, and I won't try to generalize across all our 4 funds, 4 strategies, we're looking at trying to keep individual company size in, say, an S Prime down below 1%. We're seeking to be, last time I looked at it, it's a little out of date, our largest 10 companies were less than 7 or 8% of our NAV. So for better or worse, we believe in a very high level of diversification. And therefore, we believe we can achieve our target returns with the downside protection of extraordinary diversification.
So on the point of diversification, you're working with the Wealth Channel. Many investors who this may be their first foray into private markets. How much does something like diversification rather than some other aspect of private markets matter to them? And is that one thing that they're like, we'd rather have diversification, maybe give up a little bit in terms of potential return from concentration?
Yeah,
but is that
on average, we certainly see that. Let's take our 4 strategies, right? In venture capital, for example, Spring, our evergreen venture capital fund, venture capital and growth equity, diversification is extremely important. That's not what we're doing in this fund, but diversification really important to the individual investor. And historically, until this recent growth of open architecture evergreen funds, many of the options they had were single manager. And many of them were great managers. But nonetheless, what we've seen is tremendous interest in manager diversification in open architecture.
So you mentioned different types of structures for evergreens. There's open architecture, there's single manager evergreens, there's different strategies that are now being fit within evergreen wrappers or structures. What are the pros and cons of the different types of evergreen structures out there, and why did you structure StepStone's evergreens to be the way that they are?
So in general, all right, at a very high level, you've got the non-traded business development companies that invest in private debt. Those contrast and compare with the interval funds that invest in private debt. We chose the interval fund, which has less leverage, but has a different regulatory scheme and has a different investment scheme structures that we thought were better for individual investors. So that's what we chose. There are a lot of great non-traded BDCs out there. We chose the interval fund. Interval funds walk and talk very similarly to tender funds, and that's not well understood. The primary difference is in an interval fund, the quarterly liquidity, which is typically 5%. So I will likely say just 5%. Understand it can be another number. Can't be less than that, by the way. It can be more to qualify as an interval fund. Interval funds, the redemptions, the quarterly liquidity is mandatory. In a tender fund, the independent board, and we should make this point, all of these are governed by independent boards like mutual funds. So there's a tremendous amount of robust, well-developed governance around these funds that protect investors. By the way, there are few pennies of cost in that, to be clear. And you'll see that in our schedule of fees and everybody else's. But that's what you're getting. You need to decide if you're comfortable with that. There is some administrative cost that go with these evergreen funds because they're 40 Act registered like a mutual fund. And all of ours and most of our competitors are 33 Act registered like a public company. So you're getting that. In a tender fund, the independent board can decide every quarter whether to offer the redemption. Now, if you don't, that's going to have a very, very significant impact on your business. Very, very significant impact. So the difference is more theoretical, but nonetheless, if you're running a venture fund like we are today, Spring, where we offer 2.5% per quarter liquidity in the discretion of our independent board. And we believe at this stage, and that theoretically could change in the future, but that fund, $800 or $900 million today and growing quite quickly in the U.S., gaining about $100 million a month. It's very, very successful. We believe that, and let's take these examples, right? Private debt, pretty predictable cash flows. Venture capital, less predictable. Interval fund, tender fund, 5% liquidity per quarter, 2.5%. And then our other funds sort of fall in between. But those are the key differences. You also have non-traded REITs. We don't currently have that strategy. I think those are probably pretty well understood. And those funds do have their tender and liquidity process walks and talks like the tender fund. So it is in the discretion of the board. I think we're all familiar with the headlines around the redemptions in that area. But so those are the overall strategies. Non-traded BDC, non-traded REIT, interval fund, tender fund.
I want to pick up on something that you said, particularly on the venture fund, about how with the tender fund structure, you decide how much liquidity to offer. And I think that it shows that you've been thoughtful, because your private credit fund is a different structure and liquidity
It's mandatory.
than is your venture fund. And you do that for very specific reasons. What I want to touch on is, do you think that there are certain strategies or asset classes within private markets where illiquidity actually can be a good thing, and not having the ability to make the decision themselves as allocators or investors does save them from themselves?
Well, you're now playing the role of a financial advisor in the conversations that we have, because I can't tell you the number of times we've had the conversation about liquidity and people press us, well, it's, in spring, it's not required. It could not happen. And I say, it could. That's right. And over the next 20 years, market cycles, lightning strikes, wars and floods, will there be a time in which our independent board may choose not to provide that 2.5% liquidity? Yes, that is possible. That is possible. But be sure that will happen in a set of circumstances in which that independent board, which has material investments in the fund themselves, is convinced it's in the best interest of investors. So it's a very rare event, but it's a safety valve. And I do think it's in the best interest. And what you find is we'll give that answer, and then the financial advisor sits back and says, yeah, I can't think of a time when my clients were really well served by liquidating in a panic their private investments, because they could, the ones they could. Because often they have evergreen funds and then they have drawdown funds. And those are a 15-year marriage. Let's be clear. Your liquidity as an individual investor in a feeder fund through your private bank or wirehouse or RIA is extremely limited. And if you did choose to achieve liquidity, at least today, people are working on some better mechanisms for this. Today, there would be a substantial transaction cost, and you would get a material discount to net asset value, just like when we go to buy an LP interest, we generally get a material discount to net asset value. I believe an underappreciated benefit of the evergreen fund liquidity, which again is not perfect, is you get 100% of NAV in a couple of weeks. In our S prime, it's a few days, but look at the market generally. 100% of NAV in a few weeks with little to no paperwork and no transaction cost. That's pretty interesting. And that's something, until recently, we could talk about, there were not a substantial group of high quality tools or options available to individual investors that allow you to do that. And that's what's so exciting for us, and frankly, why we've seen so much growth.
I'm going to continue playing the role of the financial advisor from a question perspective.
Right. Good, because I have experience with it.
You do, absolutely. And that's, I think, what's so fascinating about this is really understanding the how and the why behind advisors are thinking about investing into private markets and the different ways in which they can do it. So my next question related to that is, yes, I can get liquidity if I invest in an evergreen structure. That's provided for. As you say, that may vary based on the structure or the strategy. But as a financial advisor or an individual investor thinking about allocating to this type of structure, should I really think of it as an illiquid investment? And why would I want to also stop the compounding? So shouldn't I just let this continue to run? Because that's when that money at work will continue to be compounded, and I shouldn't think of it as liquid.
That is exactly right. So we don't have the 1-year soft lock on our interval funds. A lot of our other competitors do, where you have pay a 2% fee if you redeem early. But all of us would say in this industry, don't invest in my evergreen fund if you're really not comfortable holding it for a couple of years. Don't. But what you do see is investors feeling more comfortable knowing they have the option of liquidity at some point. And then the most sophisticated investors who are seeking to achieve a target allocation to private markets and are frustrated by the unpredictable capital calls and distributions that find themselves chasing their target. They never get to. Private equity in particular is pro-cyclical. In good markets, the capital comes back to you really quickly. You're a very wealthy person, 20% allocate, you've got $100 million, trying to maintain 20% in private equity. You're chasing your tail. It's very hard to do. And so what we see increasingly is, and it's in our fund and our competitors, that $100 million investor, or maybe that's your local private school endowment, putting $2, $3, $5 million in an evergreen fund, committing to drawdown funds, and then toggling their evergreen fund using the quarterly redemptions, and actually the fact you can add daily or monthly too, as it's their anchor in their portfolio that allows them to be closer. You won't be perfect, but get much closer to that desired 20% allocation.
What strikes me with what you just said is that is very much how an institution has to manage their asset allocation on a yearly basis. They need to have a certain target to different asset classes. They need to have certain returns that they hit every year. Does this become the type of product that an institution, not just an individual, starts to use 100%. As the main way that they allocate to private markets?
This is the biggest growth over the next 5 years, in my opinion. We're already seeing it. SPRIM, our core fund, is $3 billion. So it can easily take $25 and $50 million. We haven't had any $100 million investors, but we could, who would feel comfortable that they are an appropriate size in the fund. And then for Spring, there's essentially no competition for that. And unless you're one of the very largest, look, the dispersion of returns in venture capital is extreme. If you cannot be in the top quartile, you really shouldn't play, period. And so the opportunities for high quality, diversified exposure to venture capital and growth equity have been really, really limited. Now, most institutions are going to have a modest allocation to that to begin with, but Spring gives institutions the ability to go get some exposure to high quality venture capital and growth equity immediately at an appropriate size and scale, and know they are piggybacking on our ability to access, because venture is an access asset class. They're piggybacking on ours. They're paying us for it, to be clear. And so it really is interesting. So think about when ETFs came out, I think the general view was, well, that's what, the very smallest investors will do. It's even easier than a mutual fund. And now we know, right, the largest institutions in the world own ETFs. And so I do think that's the direction.
You bring up a really interesting thought experiment, which is if more institutions start to allocate to evergreen structures and make it the way that they allocate to private markets, does that, or has that started to help your efforts on the capital raising side with individuals who now can say, hey, we're investing alongside institutions in the same exact products?
It has. It's helped us substantially. But even before that, I would not want us to end this podcast without having talked about what I think is the most important thing for an investor to evaluate an evergreen fund, because basically that's what we've talked about. And we titled this, What's Your Edge? But we've talked about how do you think about evergreen funds? And if I could leave, whether it's a financial advisor or an individual investor, with one thought, one takeaway from this session, it is understand, is the evergreen fund you're considering investing in the same deals at the same time as the institutions being served by that manager? And in our case, it is. Back to why we came to StepStone. StepStone has a pro rata allocation policy. So we establish annual allocation or deployment budgets. We can't adjust those quarterly, but there's an annual allocation budget. Our core fund, SPRIM, is in our allocation wheel, we call it, for X dollars based on the expected deployment needs it has. We have a flagship private equity secondaries fund called SOF. Just had its most recent closing, quite successful. You can read about that. SOF and SPRIM are in the wheel, and they get the same deals at the same price at the same time in a proportionate way. So the flaw in the early evergreen funds, particularly non-traded REITs and non-traded, was that there were special deals for the individual investors. And what you see today from us and our high-quality peers is individuals are getting the same deals at the same price at the same time. So the key takeaway is make sure as an investor you understand what is the allocation policy.
How does an investor go about figuring that out?
It's in the prospectus, and if it's not clear, I think ours is very clear. I'll call out some of our competitors. I think they could be more clear. Ask, press, push. Operational due diligence questions can sometimes get, let's just check in the box and press on that issue. Make sure you really understand that issue. And if you get that right, and then you understand the fee structures and the competitive advantages of the manager or disadvantages, you'll make a good decision.
What are the other key questions that investors should ask when it comes to the structure of evergreen funds?
All right, so we talked about allocation policy. We touched on, but we really didn't address. Does the structure, BDC, REIT, interval, tender, match the investment strategy? So I think I gave the background for that. What are the fees? And not just what are the headline fees. Oh, they charge, 1 in 10. Is the management fee on net asset value, excluding leverage, or does it include leverage? That's really important. And by the way, in certain structures with credit funds where they actively use leverage, that may be appropriate, but make sure you understand.
What are the differences in fees when there's management fee charged on NAV with no leverage versus with leverage?
Depending on the amount of leverage. If you've got a BDC that can lever up to, well, they can't, that levers every dollar of equity with another 50 cents of debt, and you're paying a management fee on that, well, it's 50% more. So make sure you understand that. We have a few peers that will also charge on net asset value plus unfunded commitments. And we've chosen our path. It's very simple. It's on net asset value. We should talk about incentive fees too, I think. So incentive fees, they're nuanced. We charge an incentive fee in Spring, our venture capital fund. We charge that on an annual basis based on increase in net asset value. So we charge an incentive fee, 15%. Importantly, we have a life-to-date high water mark. You'll see hurdle rates, often with quarterly pay funds, which makes sense. And then for annual pay funds, you'll often see a life-to-date high water mark. I don't want to go too deep in the weeds, but the questions to ask are not only what is the headline management fee, what is it on? Are there any acquisition or disposition fees? Look hard at the administrative cost. By the way, these are regulated funds, so there's a section, a standard table you can compare, read across our fund versus everybody else's fund. I think this is a good thing. So understand the administrative cost and whatnot, and then understand the incentive fees.
So on the point about fees, before we get to other aspects of structure to think about, are we at the point where we're starting to see a fee compression game occur? Like you mentioned, mutual funds, ETFs, right. Those industries went through fee compression. Yes. Are we starting to see that, or is it still so early on in the evergreen evolution that we don't yet have fee compression?
These funds started at a point in time where, in general, there are a few early movers, but the bulk of the evergreen funds that we compete with today, at a point in time where fees in private markets are rational. And so I don't expect a lot of fee compression. S-Prime, our core private markets fund, we believe is the low fee provider in that space. It's about half the fees of some of our key and respected competitors. We don't have an incentive fee, for example, in that fund, and it's a 1.4% management fee on net asset value, and there are no acquisition, disposition fees or whatnot. So I don't see that going down. And I look across the REITs and the BDCs, I don't see a lot of fee pressure. What I do see is transparency pressure. Investors want to understand, how'd you generate that return? What are the risks in my portfolio? What do I own? And so in terms of structural changes, I think you'll continue to see more and more disclosure to tell investors what they've got, what are the risks, explain how we got there.
What you own, I think that gets to another aspect of structure. Different firms will invest in primaries, invest in co-invest, invest in secondaries. How do you think about portfolio construction?
So to start and stay on the upswing of the J curve, depending on the asset class, you need to invest primarily in secondaries. And so our funds, private credit is separate because What we're doing there is primarily direct loans and some specialty credit, which is a really interesting and I think emerging opportunity for individual investors. But the rest of those funds, the infrastructure fund, which we call structure, it's our least creative name. We got CredX for credit, structure for infrastructure, Spring for venture capital growth equity, and S Prime for core private equity. The last three invest primarily in secondaries. Now, those are to a large extent today LP-led secondaries. So you're buying assets that are closer to their maturity or realization date. Those funds also do some GP-led, which have a maturity profile that's closer to that of a co-invest. But none of those funds will do primaries to a significant degree because the cash flow profile in the embedded J-curve. Now, primaries are terrific in that they can produce a great multiple of invested capital, and the long-term IRR, if you choose the right funds, is quite attractive. But the cash flow profile doesn't fit very well for an evergreen fund.
So if I put my allocator hat on, you mentioned those last three funds mainly invest in secondaries. Yes, they're different strategies, core private equity, venture growth, infrastructure. Should I think of these as secondaries? When I'm putting my allocator hat on, is it I'm investing in secondaries? Yes, I'm getting exposure to venture growth or private equity, but this is a secondaries fund, and this is the way I get my exposure via secondaries.
I think if you're operating at that high level, you should do that. What you're really trying to do is get on-the-run continuous exposure to the private markets with high-quality general partners. And so that is more akin to secondaries, but it is, if I put my allocator hat on and I think about my investments in these funds, which are a large part of my net worth, I'm looking through what do I own in terms of private equity, infra, I own all these as you would expect. What's my mix of risk reward? What's my geographic exposure? Do I have industry concentration? I'm heavily invested in Spring, our venture and growth fund, so I have some meaningful technology concentration there, as you would expect, right? And so that's the way I'm thinking about it. I do think it'd be another podcast. The concept of lining up your portfolio as primary, secondaries, co-invest, I could argue that's a little outmoded, but that's probably above my pay grade.
An interesting question to think about here as well is just the psychology of allocators, because this is still relatively new in terms of thinking about how do you get exposure to private markets. I think you laid out very well how this is, particularly for those who've never had exposure. This is the first way in. There's continuous investment. There's reduced J-curve. All of those things make sense. But I want to go one layer deeper into the psychology of how investors allocate to this. Is this the type of thing where, one, investors say, okay, I'm allocating to this fund. This is my exposure to this strategy. And that's the simplest, easiest way to do it. Or are they thinking of this as one piece to a broader puzzle?
What it starts with the investors that are new to the private markets. They're smart people. They know their university endowments are investing heavily. They know the wealthiest people in the world are investing heavily in the private markets, and they've not had a solution that either gave them access, because we really haven't talked about minimums here today. So our funds have minimums from 25,000, minimums of 25 to 50. If you look at the market broadly, there's some funds at 10 to 100, but these are reasonable chunks. And by the way, you can invest through your IRA, which in my opinion is a very compelling opportunity to compound private markets returns in a pool of capital you're not planning to touch anyway.
And in a tax-efficient way.
In a tax-efficient way. So, although, be clear, if you had losses, you wouldn't get the benefit of those. So for the early investor, the person whose first exposure is, frankly, we designed S Prime, which is available to accredited investors, those with $1 million of net worth, to be the single ticket, full solution for a large part of the mass affluent society. People from $1 to $3 to $5 million of investable assets who do not want to get a K-1, who want one line item on their brokerage statement that has highly diversified exposure, primarily to private equity, that's global, mature, etc. That was that. As you move up the scale to larger and larger investors, we have plenty of investors who see S Prime as their core holding or Spring as their only thing. They've got $20 million, their comfort level with venture capital is, gosh, maybe 3 to 5%. Spring's perfect for that, right? Again, as you continue to go up the scale, you see people using it as that core anchor holding, a completion strategy where they've done a series of drawdown funds, some of which might be really, really interesting and unique. Maybe they have personal access. They know somebody or their private bank brought them a really interesting opportunity that has a really high return potential. So they've got those, but then they've got these anchors. They know what it's worth all the time. They can get liquidity if they want. They can add a little bit. The minimums to add to our funds, $5,000. So you do see people just dollar cost average. Lawyers, doctors who take money out of their business, say once a month or once a quarter, they just send us another check, right? That is really smart, in my opinion, like they did to mutual funds 20 years ago.
So that brings up a really interesting point on the psychology of investing, because as you say, transparency is a part of what you do, and you can see marks on a daily, if
you
not.
don't see our portfolio on a daily basis. You see what your investments.
You see NAV on a daily basis. You can see the portfolio over quarterly. Right. So there's the ability to see constantly how this fund is doing and what it's invested in. But I think from a psychology perspective, it's an interesting thought exercise, which is someone invests on a certain day or day one, it's at a certain NAV. That NAV presumably increases over time. Do investors ever think or change their behavior because they invested at one point in time when the NAV was a lower NAV? And then do they think, okay, well, maybe I'm not going to invest as much because psychologically I'm now getting in at a higher price, and how much upside is there from here? How do investors think about that aspect?
We do have a few that think that way, very few that I'm aware of. We also have some investors. So it's another way of saying, why do people ever redeem? Because our performance has been quite attractive in our view. Okay. People rebalance. S-Prime, our core fund, did really, really well the first couple of years. And it's continued to do well, but it did exceptionally well. The numbers are public. Over the first few years, it's a 23% compounded return since we started in October.
On an annual basis.
On an annual basis, of course, past is not prologue. Historical results are no indication of future, and you should read the prospectus. But nonetheless, their historical return's been quite good. So people who put in $1 have $2 plus today. And if their goal was to be 10% private equity, and now they're 12 or 13, it makes sense. They may choose to reduce the position. And the great thing about an evergreen fund is there's an easy, no-cost, little friction way to do that. Now, most investors we've experienced have continued to see their gains compound, but absolutely. And as this market matures, and I'm in favor of asset allocation, so I don't want to discourage people from bringing that disciplined mindset. I think that benefits them and us in the long term. You will have people who see S-Prime did really well. Spring did really well. Structure, our infrastructure fund, again, past is not prologue, et cetera. It was up. It's almost exactly a year old now. So the U.S. fund is up 20% or so. So, in an asset class that historically has returned less than that. So people could rebalance.
An interesting thought just came into my mind, which is you're seeing the growth of model portfolios in private markets, which seems to be one of the big coming innovations after evergreen structures themselves. You've built...
And by the way, the first begets the second.
Yep. Well, that's exactly where I'm going with this, because you've built a platform of 4 distinct strategies in evergreen structures. You just mentioned that there are times when investors may need a rebalance. Have you thought about creating a single product that spans all 4 of the strategies, that gives investors turnkey exposure across asset classes in private markets, and you do the rebalancing and make it easy for them?
We have thought about that. What I would rather see in the near term is the most sophisticated financial advisors, particularly the registered investment advisor community, who have discretion over all the assets. And we're starting to see, and I think will be a big trend, is them creating model portfolios. And so if I look at our funds, S-Prime is purchasable on a ticker without paperwork. Now, you, the advisor, have to be comfortable your client is accredited, but he's got $1 million in his account. Okay, right? You can buy with a click S-Prime. You can buy structure with a click, and you can buy credits with a click. You cannot do that with Spring, our venture fund, today. So it's pretty easy today for a sophisticated RIA to create a model portfolio with a blend of S-Prime, which would generally be the largest part of that, structure, and credits, since all of those are buy with a click products that execute through the NSCC system like a mutual fund. And we're starting to see that. I'll bet if you and I met and had this conversation a year from now, I think we'll see meaningful progress in that.
That's a fascinating thing to think about, because I think that gets to making private markets easier for investors, which you've done.
Our goal is to be the most investor-centric firm in the market. The lessons of those public company formats, where I'm very proud of our investment performance, it just was hard for investors. And making convenience wins. So our goal is to be the most convenient, efficient, and transparent firm in the market. And I believe that our aspirations to do that, I think we're succeeding to a large extent, is what's driven our success. But let me tell you, you put yourself in the seat of a financial advisor, these products, they historically were much harder, all the paperwork, all the complexity. And so it's really important for me to make your job as the financial advisor easier.
I think that's a good lead into the name of this podcast. Couldn't leave this podcast without asking the question. You've talked a lot about different, you've talked about a lot of different aspects of evergreen structures, about StepStone, your platform. But what is your edge?
Convenient, efficient, transparent. Designing funds and products from the investor backward. What is best for the investor as opposed to what's best for us? So that mindset, which permeates the products we've talked about, the scale and commitment to data and analytics of StepStone that allows us to execute the difficulties of matching inflows and outflows unpredictably to stay invested and stay on the upswing of the J curve. Those are our edges. If I go through our funds, S-Prime, Core Private Markets Fund, very good track record. If I had to pick one thing, low fee provider and high diversification. Spring, a unique product. There's just not, and we don't believe that there's another platform in the world. We're the largest allocator to venture and growth. We believe by a factor. We don't believe anyone can do what we've done with Spring, with secondaries and directs into the most sought after, the most access constrained, the historically highest performing general partners in venture and growth. So that's distinctive. Infra, we're the largest allocator to infra. And there are a number of infra products out there that are good, and they're single manager. We are broadly diversified with co-invest and secondaries. Our access to those is pretty distinctive. CredX, open architecture. We're doing direct loans, which a lot of people are doing and doing well, but we're also doing credit secondaries, which provide an interesting diversification and return benefit. So basically what we're trying to do in CredX is the interval funds can take on less leverage than a BDC. We compete with the BDCs, but we are seeking to, and can't promise that we will, we are seeking to generate a similar return profile with half the leverage. And we do that by buying secondaries and then adding a sleeve of specialty credit, which are really interesting asset class, longer conversation. That is things like royalties, lease assets, NAV loans, those sorts of things. We believe those two special sauces can allow us to overcome the difference in leverage and provide a similar return profile to investors. So that's our edge there.
You mentioned secondaries, and you talked a little bit about this earlier on in the show, that A, you're buying secondaries in many respects out of your funds for a number of very good reasons. But B, this industry, there's a few trends here. Private companies are staying private longer.
Yes.
There's a growth in secondary market and continuation vehicles. How does the growth of evergreens, how does that impact or interact with the growth of secondaries and private markets? And what does this market look like as all of those things continue to evolve?
So we got to go back in history briefly. For much of my working career, private markets, private equity in particular, operated on a lower of cost or market basis in terms of reported net asset values. And then in 2007, unrelated to the financial crisis, the accounting rules changed and we went to a true mark to market. And then, in my opinion, a number of years where there was a transition period, but basically once the dust settled out of the financial crisis, the net asset value you get from general partners today is a good mark. It's a valid mark. It's a place that you as a sophisticated seller and me as a sophisticated buyer, we'd agree that's the starting point. Now we're going to negotiate around it, but it's a starting point. That has allowed a secondary market to develop because there was a solid starting. The price discovery process is less. And because those net asset values are solid, we rely to a large extent on those for our valuations. And that's allowed evergreen funds. Like if you invest in our fund today, you're trusting our marks in part because we trust the general partners. And by the way, we do a massive amount of back testing to make sure, and we have our own overlays on this process, longer conversation. But because marks are solid, that allowed secondaries to grow, that allowed evergreen funds to exist. Then evergreen funds are the natural buyer of secondaries to start and stay on the upswing in the J curve. So one will beget the other. In terms of continuation funds, the duration on those is pretty close to a co-invest, maybe on average a little shorter, but those are known companies to the GP with track records and profiles. So evergreen funds are also good buyers of those, both in the single asset, although we're very focused on diversification, but particularly the multi-asset continuation vehicles, we're very good buyers of those. I see all of those compounding the growth. And when you go way, way back and zoom out, private equity is still an industry 50 years young. The tools that exist in the public markets to slice and dice exposure, dial in, dial out, risk manage, derivatives, that stuff just doesn't exist. And over time, with solid values, innovators can create products and exposures that serve investor needs and allow you to dial up or dial down to meet your portfolio goals.
You're hitting on a really important point, which is that public and private markets are coming closer and closer together. But it's hard to ignore the fact that there's half the number of companies that have gone public than there were 10 years ago. The majority of the companies that are 100 million plus in revenue in the US, I think 87% are in the US, are private.
Yes.
So evergreens and secondaries are almost like, they're not public markets, but they're the new way in which companies and funds can continue to hold those businesses or be in private markets while in a structure that makes sense for everybody.
Yes, it allows for liquidity without having to go public. And I said, I've been a public company CEO twice. It's for the birds. And here's a big difference too, right? When I started my career in the late 80s, if you wanted to build an enterprise of size and scale, you had to go public to access the capital. So without naming names, but perhaps, what could take more capital? What could be more capital intensive than building rocket ships? Hard to think of much, right? Hard to think of much. But yet the leading company is private and is engaged in a dozen or more rounds of venture capital financing and raised more than $10 billion and done that in a private company format. So that exists today. It didn't exist historically. Therefore, this trend of fewer public companies going public later, it continues. Now, I don't think that's a good thing for the investing public in general. If I had ultimate power, and I would change some of the regulations and make it easier for companies to go public and less burdensome, but it is what it is. And robust, highly specialized, very sophisticated private markets exist that can support entrepreneurs and business plans that are incredibly capital intensive and take massive, massive sums of money without accessing the public markets. And that trend, in my opinion, is only going to continue.
On that point, what is going forward your favorite or most interesting alternative investment?
Infrastructure, private infrastructure, is the asset class that when you add it to your portfolio, it is the least correlated with the other things you have. It's not very eloquent, but it's accurate. And I'm limiting myself to institutional asset classes. I have no opinion on crypto, et cetera. I'm just not informed. But among the major food groups, infra is the least correlated. Individual investors are highly, in the United States, underallocated compared to what you see in other developed economies. It is to some extent an eat your vegetables asset class, in that the returns are often, or in general, for a similar, you can't really say a similar risk profile. The returns are less, but the risk profile is also materially less in our opinion. So the risk-adjusted returns in private infrastructure, when you look at the trillions of dollars of need that exist for toll roads, bridges, airports, is a really, really interesting opportunity. So for me, what I'm personally allocating to in our family is infrastructure, private infrastructure.
So that's a great segue to, in part, private markets are about investing in opportunities that are compelling outside of public context. Yeah. Infrastructure is a great example. It's helping our built world. But in many respects, private markets is also about investing in people. You have, I think, a very interesting view on this as it relates to philanthropy, which is, in a sense, investing in people. I'd love to hear about that aspect of what you do and your passion around that and why.
I hate the phrase giving away money. I think it takes away personal responsibility. We try not to say that in our family. We think about investing in long-term, if not eternal, projects. And one of our values at StepStone Private Wealth is purposeful stewardship. It's really, in fact, it's in this, in our picture of our values, it's in the center of the circle. We want to be purposeful. And so we consider it a responsibility to invest those dollars that are entrusted to you in the most responsible, the highest leverage opportunities available to you. And of course, that takes time and effort. So that's the way I think about it. In specific, what we're focused on in our family is adoption and creating families. What is more fundamental than giving a vulnerable child a permanent loving home? So for us, creating adoptions and funding those, it turns out that in this country, it costs a ridiculous sum of $25,000 to $35,000 to adopt a child, on top of course, rearing the child and providing for the child. And so I'm involved in an organization called Gift of Adoption that funds the last mile, the last $5,000. So someone has gotten together $20,000 or $30,000 and they need the last $5,000. And so with a $5,000 investment, you can make a family. And that's a pretty compelling investment.
That is a compelling investment. I think it's just a great tie into everything we discussed today, which is how do you make things more accessible to people? One of the most exciting aspects of all this innovation that's happening in private markets, and particularly around evergreens, is you're giving people access to something they didn't have access to before. And it sounds like you do that in all aspects of your life.
I'm fortunate to be at an age and stage to be able to focus on things I'm excited about. And those are the two things I'm excited about.
Well, that clearly showed today. So, Bob, thanks so much
My pleasure.
for coming on Alco's Mainstream Podcast.
Thank you.
Pleasure to have you. Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going